Just stay calm. Everything's going to be okay. I will walk you through this. Here goes. Warren Buffett, quite arguably the greatest investor of all time and one of the richest men on the planet, introduced a relatively simple correlation in 2001. And it shows the relationship between the US GDP and the total stock market capitalization. Basically, it gives a numerical value on how cheap or expensive the aggregate stock market is at any given point in time. Because as we know, the pendulum swings in the market to either side, and a huge upswing can be followed by a dreadful downswing response. He came up with this after the immense dot-com bubble bursting in 2000, which crumpled global economies. He wanted to gather data, find out what the hell happened, and use it to give a better indication for the future. Hey, I'm Seth from Everything Money, and on this channel, Paul, Mo, and myself have been on a YouTube journey to simplify investing for you and coddle you when the markets look bleak. We've dedicated the last 4 years of our lives to provide you with sound information so you can make better financial decisions, especially in the face of fear. Because the more you know, the less you're gonna fear. And I assure you, prior to meeting these other investors, the drastic market swings would scare the crap out of me. But as I've learned over the past few years, a downturn in the market can be one of the best things that's ever happened to your portfolio. And it will give you a unique chance to buy up those amazing companies at even better prices. So if you're feeling a bit anxious, stay with me and we can help you get your mind right. This basic graph gives a historical trend line and can give us a general sense about where the market's been at any point in time. For example, in the past, the Buffett Indicator was 33% in 1953, 32% in 1981, a year after I was born, and 79% in 2002 after the dot-com crash. Oh, and it was 66% in 2009 after the housing market crash. And this is when I was trying to get my first job in the world, so it was a little tough. Previous highs for the Buffett Indicator were 87% in 1968 and 136% in 2000, just prior to the dot-com crash. And again in 2007, just prior to the housing market crash, it was 118%. So basically, when this number gets pretty high, the shit's about to hit the fan. And then after everything comes crashing down, this number drops below its historical trend line. So I know what you're probably thinking. Where are we now? Is the number really high, aka are we in for a shitstorm? Or is it low where markets are seemingly fairly priced? As of July 1st, 2022, the Buffett Indicator is 169%. This is actually a fall from February of 2021, where the indicator set an all-time high and crossed the 200% line. So it's important to know that no single metric can define and predict where the stock market's gonna go. So please don't make any rash decisions based on this. This is not to be construed as advice or for you to take action. It's just a fair warning that the data shows we could be in trouble moving forward. Warren Buffett stated in 2001, if the percentage relationship falls to the 70 or 80% area, buying stocks is likely to work out very well for you. If the ratio approaches 200%, as it did in 1999 and in 2000, you are playing with fire. In essence, many investors use the Buffett Indicator as a broad predictor of the stock market returns moving forward. And it's often stated that the 4 most dangerous words in investing are "it's different this time." And frankly, we've been hearing a lot of this nowadays with the rise of young, new, inexperienced investors putting trillions of dollars into completely speculative investments that have given rise to inflated and dangerous overvaluations. People have confused the rise of EV cars will lead to the guaranteed rise of EV car stock prices. Addictive cryptocurrency trading practices have gotten millions of young men into investing large portions of their income into blockchain tokens that have been completely fabricated out of thin air, and many of which have already gone to zero, erasing billions of dollars from the market. So remember, the Buffett Indicator, 70 to 80% is good valuation. Around 130% is neutral valuation, and 200% is scary. And we are at 169. So the other question that comes to mind is, did we already peak? And are we on the downhill? Do we have a long downward slope ahead? Or could this rebound and go even higher? I'd love to hear your thoughts in the comments below. So what does all this mean moving forward? By all indications, the pendulum has swung to one of the highest marks in the Buffett Indicator's existence. In general, this is bad news.
This is a bummer, man. That's a bummer.
In every past bubble, the years that followed the bubble bursting have been pretty bad. And look, we have all enjoyed an amazing run the past 10 years. Our retirement accounts have exploded. Our home values have gone through the roof. We've gotten new homes. We've refinanced at ridiculously low interest rates while we were filling our gas tanks with cheap gas and getting handouts from the government. And as we've been saying on this channel for years, this can't keep going. This is a cycle, and now it appears we're heading in a downtrend. Many value investors are expecting poor returns for the foreseeable future. And those same YouTubers who were pumping those ridiculous companies and stupid made-up cryptocurrencies are now feeling the aftermath as they watch their portfolio go down like 70, 80, 90%. Inflation is running rampant, gas prices are pissing everyone off, and mortgage rates have doubled in the past year. This does not look good. So what can you do?
What can I do?
Step one is don't panic. Please don't panic. Panic selling is the worst possible thing you could do. Once I stopped envisioning my retirement savings as a financial number that goes up and down and started looking at it as if I owned shares of great companies, I felt incredibly better when I was losing money. When the numerical dollar amount is down, my share count is the same. I am still co-owner in a bunch of great companies that I only bought because they were at a great price. And I'm certain these prices will be higher in the future. So this leads to step two, practice the unique art of patience.
Patience. Yes.
This too shall pass, and years from now, you might not even remember it. We could look back on this new recession as a simple blip on the radar. And once you learn more about value investing, you can see this recession as one of the greatest things that could ever happen to you.
I'm sorry, could you speak into my good ear?
It's gonna let you and I purchase some of our favorite companies with great balance sheets at even better and cheaper prices. Step three, make sure you're getting into good companies. Crypto is proven to be garbage, NFTs are a complete joke, and the hype companies who are paying YouTubers to talk about them have almost all come crashing down. Learn a process and separate a stock price and a company from each other. They are two totally different things. Companies are living things with employees. They have a heartbeat of cash flow, and they can have problems like excessive debt or dwindling sales. They have revenue, they have profit margin, they have shares outstanding, and they could be in a bunch or a little debt. Do not buy stocks of companies that sound like they have a promising future. Stock prices are a representative of what the world thinks about a company. The world can think that a company's stock is phenomenal, while the underlying physical company is garbage. But if you don't want to get individual stocks and you just want to buy the market like an ETF, then step four is, as always, we say this all the time, is dollar cost average. You want a dollar cost average into the market no matter how bleak it looks and no matter what the Buffett indicator is. Even with all this doom and gloom ahead, you and I should just keep buying good companies or a standard ETF regardless of the price. Sometimes we'll be buying into it high, sometimes we'll be buying into it low, but overall and over a lifetime, we will be averaging into the position that will inevitably go up in time. Time in the market will drastically beat you trying to time your buys of the market. Here at Everything Money, we are teaching you to get rich slowly and not get into some cockamamie scheme where you're trying to get rich quick. If this message resonates with you, take a slight moment to fondle that thumbs up button and give the channel a subscribe. If you want to learn more about dollar cost averaging, check out this video right here. Good luck to you investors out there, and all my love to those Everything Money community members. You know I love you.